So broker-dealers preserve customer complaint records for 4 years from the date of the record. Members are required to keep and preserve in each Office of Supervisory Jurisdiction either a separate file of all written customer complaints that relate to that office and actions taken by the member, or a separate record of each complaint and a clear reference to the files in that office containing the correspondence connected with such complaint. Rather than keep and preserve the customer complaint records required under this rule at the OSJ, the member may choose to make them available at that office promptly upon request of FINRA. So if the records aren't kept in the OSJ, they need to make them available in the OSJ if they're ever asked to promptly. A customer complaint, by definition, is any written grievance by a customer or any person authorized to act on behalf of the customer involving the activities of the member or person associated with the member in connection with the solicitation or execution of any transaction or the disposition of securities or funds of that customer. So that was 4513. How long do BDs keep the records related to written customer complaints? 4 years. You know that. Now, FINRA Rule 4530.08, customer complaints, defines a customer as any person that's not a broker-dealer with whom the member has engaged or is sought to engage in securities activities. So this is a little bit more about customer complaints. If the complaint is an allegation of theft, misappropriation of funds or securities, or forgery. So these are serious complaints. So allegation of theft, misappropriation, or forgery. Then the firm is required to notify FINRA promptly, no later than 30 calendar days after the written complaint is received by the member firm. Notify FINRA promptly. Right away, as soon as you can, within 30 calendar days. So notice this, if the firm gets a complaint, they don't always tell FINRA about it right away, promptly. They only are required to tell FINRA about it promptly if the complaint is an allegation of theft, misappropriation, or forgery. Those are serious complaints. FINRA needs to know about them no later than within 30 calendar days of receipt. Now, it's also required under this rule that the broker-dealer submit a quarterly summary complaint statement to FINRA by the 15th day of the month following the end of the calendar quarter. So still under 4530.08. Quarterly complaint summary reports filed with FINRA lots of numbers to know. 15th day of the month following the end of the calendar quarter. FINRA Rule 4120 has to do with regulatory notification and business curtailment. 4120. Notification and curtailment. There's going to be two different parts to this rule. One's going to have to do with no expansion of business, and then the other part's going to have to do with a reduction in business. So under FINRA Rule 4120, each carrying or clearing member shall promptly, but in any event within 24 hours, notify FINRA in writing if its net capital falls below either of the following percentages. So if the firm's net capital should fall below 150% of its minimum net capital requirement, the firm has to tell FINRA when, promptly, within 24 hours. Anytime the firm's net capital falls below 150% of its minimum net capital requirement. It would also be required that the firm give prompt notification to FINRA within 24 hours if the member is subject to the aggregate indebtedness requirement of Rule 15C3-1, which we covered in the previous section, and its aggregate indebtedness is more than 1,000% of its net capital. So the notification rule is the under 150%. That's the one I'm most concerned about, less than 150% of its minimum net capital requirement. It's also true when a member firm's net capital is less than 150% of its minimum. It will be subject to the rule that places restrictions on business expansion. Any time that the net capital falls below 150% for more than 15 consecutive business days, provided that FINRA has been notified of this condition for at least 5 consecutive business days. No member may expand its business during any period in which FINRA restricts the member from expanding its business for any financial or operational reason. So expansion in business includes hiring more registered reps, exceeding average capital commitments, initiation of market making in new securities, exceeding average commitments over the previous 3 months for underwriting. Expansion of business also includes opening new branch offices, entering any new line of business, making unsecured or partially secured loans, or any other activity that FINRA deems appropriate under the circumstances. So this is like the first level. So first, the notification is under 150%, and then the first thing that FINRA would do is say, okay, you're getting close to making us really nervous. Your net capital is getting to be too close for us, so we're not going to let you grow your business during this period of time. Now, if your net capital falls even more, if the firm's net capital is less than 125% of the minimum net capital requirement, so that's even worse, okay? So this was the first level. Now, reduction in business occurs when the net capital is less than 125% of the minimum. Now, FINRA has the right to say, we're going to require you to reduce your business so that you can get your net capital back in line with what is required under this rule. So the same rule applies as before. A firm will become subject to the reduction in business if the net capital falls below 125% of its minimum net capital for more than 15 consecutive business days, and FINRA has known of this condition for at least 5 consecutive business days. Reduction in business shall mean reducing or eliminating parts of a member's business in order to reduce the amount of capital required. Promptly paying all or a portion of free credit balances to customers. promptly effecting delivery to customers of all or a portion of fully paid securities. Introducing all or a portion of its business to another member on a fully disclosed basis. These would all be under business reduction. Reducing the size of their inventory. Ceasing market making. Closing one or more existing branch offices. Collecting unsecured loans. Accepting no new customer accounts. That would be under the reduction of business. Restricting the payment of salaries or other sums to partners, officers, directors, shareholders, or other associated persons. Affecting liquidating or closing customer or proprietary transactions. Accepting only unsolicited customer orders or any other activity that FINRA deems appropriate. So under 4120, there's the notification rule, so under 150%, and then there's the restriction on business expansion, still under 150%, and then reduction in business under 125%. So I would definitely know those numbers. FINRA Rule 4360 is the fidelity bond rule. Broker-dealers that are required to join the Securities Investor Protection Corporation are required to maintain blanket fidelity bond coverage. This blanket fidelity bond coverage provides protection against loss and has insuring agreements covering at minimum the following: fidelity on premises, in transit, forgery and alteration, securities, and counterfeit currency. The fidelity bond must include a cancellation rider providing that the insurance carrier will use its best efforts to promptly notify FINRA in the event the bond is canceled, terminated, or substantially modified. A member shall immediately advise FINRA in writing if its fidelity bond is canceled, terminated, or substantially modified. A member's fidelity bond must provide for per loss coverage without an aggregate limits of liability. So it's a blanket fidelity bond. The fidelity bond coverage must provide coverage for any person associated with the firm, except for directors or trustees who are not performing acts within the scope of the usual duties of an officer or employee. So it doesn't say exactly which associated persons are covered. It's a blanket. That's what that means. It covers all associated persons. Each member firm with a minimum net capital requirement that is less than $250,000 must maintain a fidelity bond with a minimum coverage of the greater of 120% of its minimum net capital requirement, or $100,000. So the greater of. So fidelity bonds. Now, most members are members of SIPC. Not all, but most broker-dealers are members of Securities Investor Protection Corporation. So if they are a member of SIPC, they must have a fidelity bond. If their net capital is less than $250,000, the amount of the bond (120% of net capital) or $100,000. Firms that have a net capital requirement of $250,000 or more use a specific table that tells them exactly what the requirements of the bond is. Now, notice it's the firm's responsibility to notify FINRA if there's a change to the bond. And it's the insurance company's promise to try to make reasonable efforts to notify FINRA if anything should happen to the bond, use its best efforts. But the company, the insurance company uses best efforts. The member firm must notify FINRA. Now, it is true that FINRA Rule 4360 exempts from the fidelity bond requirement firms that are in good standing with a national securities exchange that maintain a fidelity bond subject to the requirements of that exchange, so long as the requirements are equal or greater to the requirements under this rule. So the requirement to post a fidelity bond has to do with the firm is a member of the Securities Investor Protection Corporation. Broker-dealers that only sell mutual fund shares are not required to be members of SIPC. As such, they would not be required to post the bond either. NASD 1017 has to do with the application for approval of change in ownership, control, or business operations. So broker-dealers that are members sometimes do something that changes their membership in a way in which they have to file what's called a CMA, which is a continued membership application. NASD Rule 1017, continued membership application. A member shall file an application for approval of any of the following changes to its ownership, control, or business operations. A merger of the member with another member, unless both are members of the New York Stock Exchange, or the surviving entity will continue to be a member of the New York Stock Exchange. Member shall file an application for approval of a direct or indirect acquisition by the member of another member, a direct or indirect acquisition or transfer of 25% or more in the aggregate of the member's assets, a change in the equity ownership or partnership capital of the member that results in one person or entity directly or indirectly owning or controlling 25% or more of the equity or partnership capital, or a material change in business operations. So if who owns the firm is changing, or if there's a material change in business operations, there's a merger. This requires an application for approval So material change in business operations under the NASD rule include, but are not limited to, the following: removing or modifying a membership agreement restriction, market making, underwriting, or acting as a dealer for the first time, or adding business activities that increase the minimum net capital required. So the member fills out an application in the manner prescribed by FINRA with the Department of Member Regulation. So application filed with FINRA's Department of Member Regulation. It's filed electronically. It includes a detailed description of the change in ownership, control, or business operation. When does the application have to be filed? At least 30 days prior to the change. At least 30 days prior to the change. I would definitely know that. A member can file an application to remove or modify a membership agreement restriction at any time. And yes?
Can you repeat that? It popped right when you said membership.
Okay, perfect. A member may file an application to remove or modify a membership agreement restriction at any time. A member may file an application for approval of a material change in business operations other than the modification or removal of a restriction, also at any time. But when the application is filed for an approval of a material change in business operations, the member cannot affect such change until the conclusion of the proceeding. So basically until they're given approval. So the Department of Member Regulation gets the continued membership application form. They need to look at it. They have 30 days to reject it as not being substantially complete. So they need to look at it within those 30 days. If they reject it as not being substantially complete, it will be deemed to not have been filed. Once it's been filed, if the Department of Member Regulation wants any additional information, they must ask for it within 30 days after the application has been filed. The applicant is required to file any additional information that they're asked for within 30 days of the request. If the applicant files a CMA form and wants to withdraw the application, they may do so within 30 days. FINRA will refund the application fee less $500, which is retained by FINRA as a processing fee. The Department of Member Regulation may request that the applicant participate in a membership interview. If they want to request an interview, they still have. So there's a lot of things within this 30 days. So the application is filed. So the Department of Member Regulation has 30 days to reject as incomplete, to 30 days to ask for more information, 30 days to request an interview. If they request an interview, the Department of Member Regulation must give the applicant at least 7 days notice before the interview. So they must tell them at least 7 days in advance of the date and time of the interview who is required to be there. The membership interview is required to be conducted in the district office for the district in which the applicant has its principal place of business. If the department requests an interview, so if they go through this interview process, after the interview, they must decide within 30 days on whether or not they're going to give approval to the continued membership application if there is an interview. If the department does not require that the applicant participate in a membership interview, if they do not ask for additional information, then the department is required to serve a written decision within 45 days after the filing of the application. The decision shall state whether the application is granted or denied in whole or in part. Provide a rationale for the department's decision. So when there is no interview, from 45 days from when the application is applied, it will either be approved or rejected, in whole or in part. If no interview. If the department shall fail to serve a decision within 180 days after filing of an application, the applicant may file written requests with the FINRA board requesting that the FINRA board direct the department to issue a decision. So some information under NASD Rule 1017 as far as the application filed, it's called continued membership application, whenever there's a change in ownership, control, or business operations. If the department approves an application under this rule in whole or in part, the department may require an applicant to file an executed membership agreement. Under the Securities Exchange Act of 1934, Section 14 deals with proxies. We already sort of talked about proxy statements and said when a member firm receives a proxy statement on behalf of a shareholder, the member firm shall promptly forward the proxy statement to the shareholder. The SEC requires that shareholders of companies whose shares are registered receive a proxy statement prior to any shareholder meeting, whether or not it's an annual meeting or a special meeting. The proxy statement must be filed with the SEC before soliciting a shareholder vote. Items which shareholders are asked to vote include election of the board of directors and approval of many corporate actions, such as tender offers. A tender offer is an offer to purchase some or all of the shares of a company, usually at a premium to market price. Tender offers may be friendly or unfriendly. The SEC rules require any corporation or individual acquiring 5% or more of a company to disclose information to the SEC, the target company, and the exchange where the securities trade. Proxy statements, solicitations, whether they're made by management or shareholders, must disclose all of the relevant facts that the shareholders would need to cast an educated vote. The SEC has proxy rules that describe the specific information that must be found in these solicitations. So, proxy statements, solicitations. Every year I get a proxy statement for the shares that I own. I don't own a lot of individual shares, but I do own a few. And I'm the kind of nerd who reads that stuff. I read all the information that I should know to make an educated vote. I don't actually go to the shareholder meeting. I usually just vote online, but you can go to the shareholder meeting if you like. Now, it is Section 14 of the Securities Exchange Act of 1934 that talks about the rules as far as proxy solicitations go. I want you to make sure that you read the rule in its entirety. I'm not going to read the whole thing to you. I will just highlight the most important parts of it. Broker-dealers that carry customer accounts must give proxies received to clients. The withholding of proxies is a prohibited practice. That seems common sense. Anytime a shareholder is going to be asked to vote, whether or not it's at an annual meeting or a special meeting, they must be given the proxy statements prior to the annual or other meeting. There's also special rules that relate to tender offers, so we referenced that already. Also under Section 14, any solicitation or recommendation to the holders of a security to accept or reject a tender offer or request or invitation for tenders shall be made in accordance with the rules and regulations that the SEC may prescribe as necessary or appropriate in the public interest or for the protection of investors. It is unlawful for any person to make any untrue statement of a material fact or omit to state any material fact necessary, so that the proxy statement must include all material facts, so that the person being asked to vote on such a thing like a tender offer must have everything they need to know to make an educated decision. That concludes our discussion of Section 3B. Remember, you want to read those key facts a minimum of 3 times before you go and take and pass your test. There is a section quiz that follows, and then there is a final exam for all of the information covered in critical function number 3. Make sure you take it as many times as you need to get to 90% or better. Don't take it more than once a day though. Have fun.